So let's look at how this plays out. This is what happens, okay? First, you have a yield curve inversion indicated by red. That's the first step. The second step is you have the Fed funds rate climbing, plateauing, and then dropping. Coincident or latent with that happening, with the Fed funds rate climbing, going flat, and dropping, you have the stock market peaking out, usually a little later, and usually crashing after that fact. And usually it crashes to its bottom after the Fed funds rate has gone all the way back to zero, or basically back to zero. That happened in the 2000 bubble, that happened in 2008, and that happened briefly in COVID, where you have 1, 2, 3. You have yield curve inversion, Fed's fund rate up and down, stock market crash. Yield curve inversion, Fed's fund rate up and down, stock market crash. Again, here, there's a little red blip. It's hard to see, but even in COVID, yield curve inverted briefly. Fed's fund rate up, down, stock market crash briefly. It seems to be somewhat commensurate with the size of the yield curve as well. Well, what do we have right now? We have the largest and deepest yield curve inversion that we have seen in over 40 years. This is bigger than 2000. This is bigger than 2008. This is no small yield curve inversion. And so if we go back again to this chart here, what does this massive yield curve inversion indicate? What is it predicting for us? Well, it's showing that there's a recession coming. And so what's the sequence? The yield curve inverts, the Fed raises the interest rates via the Fed funds rate, and that's exactly what they've been doing. And they're nearly done raising it. It seems like they're beginning to plateau. Well, what happened in the past cycles? The exact same thing. We have it raising, plateauing, and then dropping. And see how the crash occurs? If you look at the Fed funds rate right below the stock market crash here, you can see that it went back down to zero. That's basically the bottom. Now, I want to introduce one more thing, and this was not present in any of my past videos, and that's the fact that we also have another correlating and corroborating metric. That is the unemployment rate. Notice how every time the stock market crashes and it's at its bottom, the unemployment rate is at its, or near its top. See, here's the stock market crash in 2008. Here's the unemployment rate near its peak. And if you line it up, it's right there. It's near the peak, right? And what do you have also conversely? You have every time the unemployment rate is near its lowest is when you're at the peak of the stock market. That's very interesting, because where are we right now? We're at the lowest, or near the lowest. And what do we have? We're almost making a new all-time high. It matches almost perfectly. And so I'll give you another example. Back in 2000, so we had the yield curve invert, we had the Fed's fund rate increase, decrease. We have a crash right here, stock market crash in 2002, the bottom, right? And that is approximately where the peak relative to that cycle was for unemployment. And let's look back even further. How about the peak before that? The best time to sell, right? In 2000, August 2000, unemployment was at its absolute lowest. This pattern repeats, just like all the other patterns repeat. So how can we use that? We can use that by not only looking at when the Fed funds rate flattens off and begins to drop, because that's telling in itself, but we can also look at the unemployment rate right down here. And we know that we're not near the bottom of the crash because unemployment is basically at its lowest ever. We need to see unemployment start to go up. And that's exactly the Fed's goal, if you haven't been listening. So when the unemployment rate begins to climb like this, that's when we know we're getting toward the bottom of the stock market. That's when we know the bottom will occur. Because when we're at the high, or the relative high, that's where the stock market has crashed to its bottom. So people who think that there's not a crash coming are ignoring everything on this chart. All four of these charts they're ignoring. They have their heads in the sand and they're saying, we're going up and to the right, up only. Who cares? Who cares about the unemployment rate? Who cares about the Fed funds rate? Who cares about the yield curve inversion, which all say the same thing? They all say that a crash is coming and that it's not yet. Okay? So when we see the unemployment rate climb, when we see the Fed funds rate flatten off for maybe a year and then begin to drop, red alert, like the stock market crash is coming. And I don't say this to be negative. I'm saying this because it's what the charts are showing and it's what the government has given us. You know, they didn't hand us gold on a silver platter. They handed us shit. So now we have to deal with that. And so we need to be nimble and we need to be able to turn a disaster, a manufactured disaster, which none of us wish was happening, into an opportunity. Because any disaster can be turned into an opportunity if one is positioned correctly. And that's what my entire thesis is about for the next several years. Now, that doesn't mean that we're immediately crashing, because note there's some delay to all of this. Again, we're at the lowest point of unemployment. We're at the beginning stages of flattening off for the federal funds rate. And what we have seen in the past, let's look right here. When the federal funds rate first flattens off right here, what do we have with the stock market directly above it? Look at this. From here to here is a massive climb from September 2006 to November 2007. We have the market climbing. That's why the market is climbing right now, because it can remain irrational longer than we can remain solvent, longer than we would expect. It doesn't make sense. You know, we just had a yield curve inversion. The market should be dumping. And it is, but it's in slow motion. It's a slow motion disaster. It's a very slow motion lag. The lag fools everyone. Everyone thinks that the markets are doing great. I guarantee you, in 4 to 6 months, if the market continues going up, people are going to be so damn bullish. When it breaks its all-time high, people are going to be so freaking bullish. Oh my God, all-time highs. The stock market is breaking new all-time highs. Recession canceled. Watch this. The headlines will say this. Recession canceled. There is going to be a devastational crash after that. Do not be fooled. Unless it invalidates every chart that you're looking at right here and the past 30 years of data or more. Now, it depends on what time frame. I think I'd have to add that caveat because, you know, if you only plan, like I said at the beginning of this video, if you only plan for the doom and gloom situation, you could miss a tremendous euphoria, tremendous parabolic climb up before that crash. Now, it's a bit of a game of chicken because when do you sell? That is the guess. And I'm not trying to say that I am going to tell you exactly when that is because I don't know. I'm playing the game of chicken here with you. I'm trying to guess it correctly so that I can take profits and then not have all my holdings subjected to the biggest downturn over the next several years that we have seen in 30 years perhaps. But it is a long lag, and that's why so many people get fooled.